The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and welcome to Simple Rules for Lower Risk Stock Entries for the first hour, and then for the second hour at 10 a.m. Eastern Standard Time, we will have Larry Gaines presenting some strategies related to options trading and how to use options to generate income and how to properly price options and how to avoid newbie option trader mistakes. So this is a two-part webinar. First part, myself, Mark Helweg, I will speak on simple rules for lower risk stock entries, and this will actually go beyond stocks, but I will include many stock examples. And then again, Larry Gaines will present the second hour as well. So let's go ahead and get started to make sure we stay on track for the 1 hour time period here. I am going to do a quick sound check. So good morning, everyone. Can you type in an S if you can see my intro slide here? Simple rules for lower risk stock entries. Excellent. Now, forgive me. I did the wise thing by moving into the allergy capital of the world, I think, which is Austin, Texas. So sometimes I run into issues with my allergies down here, and I sound a little funny, so I apologize for that. But I guess it's part of life. Austin is actually a very fun city to live in, and the benefits far outweigh the challenges. So, all right, well, I'm going to go ahead and dive right into this again. Welcome to the Simple Rules for Lower Risk Stock Entries webinar. Now, for those of you who don't know who I am, I have come from the hedge fund background over the past 20 years or so and focused specifically there on developing quantitative trading models and also developing different indicators that could be used to forecast price. I'm probably most noted for developing the value charts concept and have written a book called Dynamic Trading Indicators, published by Wiley back in 2002, and then also have been a speaker at both domestic and international trading events. Now, one fun thing I like to do, this is a little bit early in the morning to be doing this, so I apologize for that. But having said that, sometimes I like to point out fun places to go and eat if you ever travel around the United States. Now, this does not look appetizing, mind you, but there's a funny story behind this. So this is, this presentation has been recorded, by the way. But one person, Jim, commented, Atlanta is the pollen capital of the world. I feel your pain there. Now, Dyer's Hamburgers or Dyer's Burgers in Memphis, Tennessee, their claim to fame is 100-year-old grease. All right, now, so that just makes you want to run. But they make the best hamburgers, or some of the best hamburgers I've ever tasted, and this is exactly how they cook them. Now, the funny story behind this is they actually had a downtown location, and they decided to create another location out in the suburbs, and so they transported half of their 100-year-old grease to the new location, and they had a police escort for their grease. So that is their claim to fame. I don't know how they get around the different rules with the the Food and Drug, I guess, for restaurant guidelines for that type of thing. But I don't think it's a dirty restaurant by any means, but it's very clean. They just have 100-year-old grease. So what they do is they throw your hamburger patty on top, and it literally floats, and then they flip it on top, floating on the grease. And so that's how they cook it. But I have to say, this was back when I was in college more than anything, but it was an amazing hamburger, and it's certainly worth the risk. I guess each hamburger takes about a year off your life, so you've got to balance the pros and cons there. If you ever go to Memphis, Tennessee, and you're downtown on Beale Street, check out the Dyer's Burgers if you have the appetite to try something like that. All right, so let's go ahead and dive right in. Yeah, let's see. A few comments that you guys are presenting here, funny relating to this. Now, risk disclaimer, trading or investing carries a high level of risk. It is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This can all be summed up in the idea that if you cannot afford to lose the money that you're trading with, I strongly advise that you don't trade. Okay, and the reason why is because we obviously expose our money to the potential of profit, but also we expose it to the potential of loss. And the reality is that most traders lose money in the market. So just be careful. We are learning today strategies that we want to use to make money in the markets. But having said that, I would not be able to sleep at night if I knew that you were trading with money that you could not afford to lose. So just my personal opinion there. Secondly, we're not going to be reviewing any type of hypothetical or simulated performance results per se. We will look at some examples in the markets, but CFTC Rule 4.41 states that hypothetical or simulated results have certain limitations. Basically, past performance is not necessarily indicative of future results. Simple rules for lower risk entries. Now, what I want to do is just really dive right in here and talk about some of the rules that we're going to be going into more detail with today. But it boils down to just focusing on a few things. Let me get my pen out here. First and foremost, make sure that you have the right trading tools. Now, this may sound a little strange at first to some of you, but the reality is if you work to understand what each trading tool does or understand the function of each trading tool, then you're going to see why this is so important. So if you don't have the right trading tools, then you're not going to be able to see everything that the market has to say to you. So this is very, very important. And I'm going to show you my opinion on what those tools are. Enter the markets on the right side of value. Now again, this is a statement that people don't understand in the markets as easily as they would understand outside of the markets. So the analogy there would be is if you go to buy a used car, obviously you want to buy a used car at the very most. If you're paying for it, you want to buy it at fair value, but you would prefer to buy it even undervalued, moderately undervalued, or find a steal out there where the used car price could be significantly undervalued. Then I'll get to questions here in just a second. Jim, is value based on market profile? No, that's actually a really good question. It's not. Market Profile was developed by Peter Stottlemyre. That's one of the first books I actually read as a trader back in the late 80s. This is not, but this is very complementary to Market Profile, what I'm going to show you today. Now, again, so value in the outside of the markets, we think of value and we understand value. And what we're focusing on is objective valuation. It's not subjective. So a strange thing has happened over the years, and that is when we talk about value outside of the markets with used cars or with housing markets, any free market, we talk about objective market valuation, and that's what I'm referring to here. So buying on the right side of markets according to objective market valuation. Now, strangely enough, over the years, when we think of value in the markets, we think of subjective market valuation. The opinion of an analyst who 9 times out of 10 doesn't even trade the market that he's stating an opinion on. We don't care about that because those opinions can be wildly inaccurate, and they have been wildly inaccurate. Okay, we care about what the active traders think who participate in the market that we're trading. We care about transactional price history. That's the ultimate vote of what a trader believes is the valuation of a market, if you will. So we're interested in trading on the right side of value. We do not want to buy overvalued or sell undervalued as a general rule. Now, getting out of a stop, if market goes against you, that's another story. All right, but it's a general rule, especially when entering a market, you want to enter markets on the right side of value. Now, number 3 here, enter markets with confluence strategies. What does that mean? That's basically relating to taking a number of very valid indicators and seeing if they can all line up to tell you the same thing. So if I'm using value charts, for example, along with momentum, along with a price pattern that hits a trend line, then I have 3 indicators that have the potential of all saying the same thing to me, all projecting that price could go a certain direction. So confluence strategies deal with several indicators projecting price to go a certain direction at the same time. And so all that does is increase the probability that price will indeed go that direction. Number 4 here, I believe in entering markets with drill down analysis. That means if you have a bullish formation or a bullish pattern on a longer term chart, then you want to drill down and find more confirmation or bullish signals on a shorter term time period. So if I have a weekly bullish pattern on a chart, I want to drill down to dailies potentially, drill down to 60 minutes, even beyond that, and find strategic entry points all in the same direction. And you'll find that you can do amazing and very, very powerful things if you combine the right trading tools with number 1 and drill down analysis here with number 4. Now, number 5 here is always be aware of market reports and earnings announcements. This is a shock factor that can and will enter markets, and this is going to cause prices oftentimes to jump in a certain or gap in a certain direction or move very aggressively in a certain direction. The reality is unless you have insider information, which is illegal, we don't know which way the market's going to react to the report. And these type of reports cause a value realignment in the market. So it's important to understand that we have a pre-announcement valuation and a post-announcement valuation, and those are going to be different oftentimes in the markets. Okay, so these are the 5 things I would say focus on. I'm jumping into the core points early here, but let's go ahead and drill down and talk about each one of these things. Now, when I talk about analyzing a market, I'm talking about including the primary components of analyzing a price chart. Now, why do we care about analyzing a price chart? Because a price chart is reflecting the psychology of a market and can be a very, very powerful tool in understanding when buyers are getting tired, when demand's getting tired and supply is kicking in, or when supply is overwhelming demand or demand is overwhelming supply. It's very, very powerful. This is proven many, many times over again in history. So what I find interesting is a lot of top universities out there do not acknowledge technical analysis as much as they should, although this is changing. This is becoming much more prevalent. But when I talk about technical analysis, then I talk about what tools do you need to give you the complete picture of analyzing the market. Yeah, Fred, this is being recorded, by the way. Now, this can be, in my professional opinion, 20 years in hedge funds and whatnot, this can be broken down into 3 primary components. Okay, so the 3 components of technical analysis. The first component I'll tell you is cost. When we look at a traditional price chart, an open, high, low, close, or a candlestick chart, that falls under the cost area. That's showing a price history or a cost history for that particular stock, futures, or Forex market. Fairly straightforward. Now, cost is beneficial from the standpoint of being able to allow us to detect current and historical trends, support and resistance levels, and find chart patterns that have some sort of predictive ability. So cost is relating to the most widely used market analysis tool in the world, and that is the traditional price chart. Very, very important. I always have a cost chart or price chart displayed. Now, a lot of people use these terms interchangeably, price and cost. Okay, and I'm not trying to buck the trend here, but the reality is that there's different components of price. There's the cost component. There's also the value component. I'll get to that in a second. Now, the second component of technical analysis has to do with momentum, the velocity of price in a certain direction. A market can lack momentum or have very strong momentum. And momentum can oftentimes be strengthened by a strong volume picture as well. So I always try to have some sort of a momentum tool up on my screen as well. Last but not least is value. And this is the really interesting part of the analysis, is that over the years the market has not even acknowledged the value picture. Now, up until recently, we haven't had a tool that can actually communicate market valuation to us, but as an engineering student in college, my whole goal was to create that first model that could properly construct market valuation, and that's what value charts is. So when I analyze any market, I include these 3 as a general rule, these 3 tools and more. So, but at a very minimum, if I don't have tools that speak to these 3 components, then I'm missing part of the picture. Now, remember, there may be some trading strategies or breakout, opening range breakout, or candlestick patterns that we can use to trade without necessarily having all three of these. But when I'm doing technical analysis and trying to determine which way a market's going to go, I always try to have all three of these tools at a minimum on my charting window. So traditional price charts display the cost of an asset and the cost history. Momentum indicators display, obviously, momentum, the velocity of prices. Value charts is a new tool that's come out that I developed a number of years ago, and we've made it available in the broad market with a lot of platforms here over the past couple of years, and that's designed to communicate objective market valuation. Now, objective value guidelines, let's talk about valuation. This is very important to understand. A lot of people don't understand the implications of value, so let's go ahead and jump in this. Excuse me. So value is subjective. No, value is not subjective, Chris. Value is actually objective. Everything that we're talking about with value charts is not derived from my opinion about the markets, but it's derived from analyzing historical transactional price activity to give us a picture of what the market thinks is fair value, what the market thinks is overvalued or undervalued for a particular time frame. Now, when you think of valuation, very important to understand, an overvalued market can become more overvalued. So just because you have an overvalued condition or situation does not mean that prices are going to snap back and go back down to fair value. It can, and it often does, but it doesn't guarantee that. Okay, an undervalued market can become more undervalued. So again, an undervalued situation or for a market and price combination, market and time frame combination, does not ensure that we're going to see a market bounce back up into fair value. Now, just because we understand this does not eliminate the power of value. I'm going to show you why that is. Markets can experience value migration. That's one of the options. And that's where you have a value realignment across one or more of the time frames for a particular market. Secondly, markets can and often do experience what we call value reversion. That's a snapback. So if a market becomes overvalued, then it oftentimes snaps back to fair value. We have more sellers jump in. They recognize an opportunity or an overvalued condition in their opinion, and they push values back, or mark the prices back down to fair value. And the equal and opposite situation is where markets or prices are undervalued according to value charts or a value measure, and then demand kicks in, buyers kick in, and recognize an opportunity to buy at an undervalued price level. Number 5, value is time dependent. Very, very important to understand. It's possible for a market to be overvalued short term and undervalued longer term. Now, again, this makes it a little more challenging to understand the true nature of value with any market, but it makes it a lot more powerful, and that's what we want to dig into. That's what we want to take advantage. And I'm going to show you a drill down approach to taking advantage of this fact that value is time dependent across different time frames. Now, number 6, value acceptance is excuse me, I have this backwards. Yeah, that's right, time at price. Okay, so value acceptance really means that we see a market zip up and become very overvalued, and then all of a sudden it starts remaining in that price level. So it zips up and then goes into consolidation right away. What that really means is that it starts to leave that fair value or significantly overvalued state. It becomes less overvalued, and eventually if it keeps on trading at that same price level, which was once very overvalued, it will become fair value. All right, so that's what could happen because markets, as prices continue to trade at a certain level, then that produces market acceptance or value acceptance, and you see what was once a significantly overvalued situation become more fair valued over time. Okay, now let's go ahead and go to the next slide here. When we see buyers and sellers come together and prices are essentially stable, what that's telling us is consolidation areas represent a balance of buying and selling. It represents really an equilibrium in the market with supply and demand. Now, if prices zip up and there's no other change in the market or the opinions of traders, then much higher price levels will tend to attract stronger selling power. So as we start to see prices zip up, what happens if there's no other change in the mindset of the traders involved or actively trading in the market is we have more sellers step in, and what this does is typically push prices back down. Opposite situation is if prices trade much lower, and this tends to attract stronger buying power. So in the absence, again, of any other factors that change the valuation in the minds of traders, we see buyers step in and tend to push prices back up into a fair value time frame or fair value situation for a given time frame. So how can we enter a market strategically? That's really the question that we're after. Value, momentum, price, just as a topic in and of themselves, we don't care about that unless it can help us enter a market strategically and help us forecast future prices. Market entries will determine more than exits the outcome of your trade. This is a debated point, and I respect a lot of technical analysts who have a different opinion on this, but my opinion is that your entry is going to determine the success or failure of your trade more than anything else, much more than exit. All right, let me give you a quick analogy. Is there a normal time period for value? No, actually, there's not, Frank. There's a unique time period for valuation across a market. So there's basically three categories: short-term, intermediate, and long-term valuation. We'll touch on those here in just a minute. So let's get back to this idea. Market entries determine more than exits the outcome of your trade. What do I mean by that? Now, consider an analogy in the real estate market. When I was down in the Cayman Islands, my realtor called me up and said, "Mark, there's a condo coming online. A lady regrettably has passed away, and her family wants to dump her condo." And so this was coming in literally about $100,000 below the average or the fair value as I could see it in the market. And so I just told my realtor to buy it. So just buy it, because I figured that if I bought this condo significantly undervalued, then at the very worst, I could turn around and sell it very quickly up in fair value. All right, so that's my idea. Now, I knew with the entry price of this condo, again, if I buy it significantly undervalued and there's not a dramatic change in the fundamentals of the market, then I should be able to turn a profit and be very, very safe in taking advantage of that. So literally before my realtor's office even opened up, I told him I wanted it. We closed the deal, and upon opening, literally in the first 15 minutes of being open, they had 5 other offers on the condo that were even higher than mine. So that's how fast these entry price opportunities can come and go in the markets and in real estate or used cars or whatever the free market is. But because I bought significantly undervalued, then I was able to be below fair value and be in a situation where my risk was dramatically reduced there. All right, so that's why I believe that entries are so important. If you get in at a very attractive valuation level, get in on the right side of momentum, on the right side of value, and using price strategically, then chances are that you're below the valuation of a market. Chances are that the market forecast also is going to be favorable for you. So you're in the driver's seat once you have a degree of separation, locked in, or not locked in, but unrealized profits. Then you have a lot of different attractive opportunities. You can put a break-even stop in. You can look at different types of exit strategies as well. So focus your efforts on entering markets strategically more than anything else. That's my opinion. Your most strategic entries will typically involve a confluence of price, value, and momentum. Let me just get a quick drink of water here. Just 1 second. Okay, again, I apologize, struggling with allergies down here in Austin, Texas. If your chart analysis does not have price, value, and momentum, then you don't have the complete picture of what a market's doing. So, over the years, I talked to a lot of different traders. I've met hedge fund managers and all the above. And what I found, which is interesting, is a lot of times you'll have purists. Sometimes you have people who just trade price action. And all they look at is price, and they can try to infer, if you will, the value or momentum component of price. But at the end of the day, it's very difficult to do, if not impossible, to a certain extent. And so really what they're doing, you can become very good at price action and be a profitable trader. There's no doubt about that. But if you just look at price, you're missing the value component and missing momentum, and you don't have nearly as powerful of analysis as you could. So if you're great at price action and you're not looking at value, you're not looking at momentum, then in my opinion, you're leaving a lot of money on the table because you're missing that added information that can only make your analysis better. Likewise, if I become great at value and not price and momentum, I could probably become a profitable trader, but there again, I'm missing two other very important components. When I say price, I mean cost in analyzing the market. So all three of these, very, very important. If you don't have all three of these, then you do not have a complete picture of what a market is doing. Excuse me. Value is one of the most misunderstood characteristics of any exchange-traded asset. And the reason why is because historically traders have referenced subjective market valuation instead of objective valuation. Okay, so when you think of value, again, outside of the markets, this is really easy. We all understand it. I'm going to find a good value. I'm going to buy a shirt, or I'm going to buy a tank of gas, or a used car, or a house. Good value is something that's coming in under fair value in the market. We understand that. But for whatever strange reason, people hop in the markets, and one of the biggest misconceptions that new traders have is that because all the buyers and sellers are paying the same price at any given point in time, that price level represents fair value. It does not. Even on the CNBC or CNN, when you watch those shows, Money, what's interesting is they settle out every day and they say, this stock is closed at a certain fair value. That's not correct. That closing is not fair value. It can be, but it doesn't have to be. So they're really behind the times. I mean, dramatically behind the times, I would say, in terms of understanding the value. Okay, yeah, exchange. Thank you. Exchange traded. Need to correct that typo. Appreciate that. Now, value is the relative attractiveness. Again, hedge fund managers were not the best at typing, so I apologize. The relative attractiveness of an asset across a price continuum. Okay, not relatively, but the relative attractiveness of asset across a price continuum. And what we're really focusing on is objective market valuation. We don't care about subjective. That has to do with the talent of the analyst, right? So objective market valuation, and that attractiveness is very important. That creates an invisible force field around every market across every time frame, meaning that in the absence of anything else, if prices start to shoot up, they start to become overvalued, and we expect a value reversion back down to fair value. If prices start to sell off very quickly in the absence of new information, we expect buyers to come in, undervalued conditions to exist, and they typically push prices back up to fair value. This creates what we call a value reversion. All right. Now, new objective value trading tools. For those of you not familiar with value charts, let me just give you a quick and dirty rundown of what they are. This is a traditional price chart displaying the cost component of a market on the top here. On the bottom, this is what we call a value charts price window. They share the same time axis below. So a bar up here corresponds to a price bar directly below. Now, the difference here is that the value charts price window, actually let me show you two things. First of all, if you look at the zero axis here, which is linear in the value charts price window below, if you saw that plotted in the price chart above, it would be a simple moving average, if you will, that lags the market just a little bit, of what we call a floating value axis. Okay, nothing new and innovative about that. Can be helpful, but that doesn't really give us the power we're looking for strategic market entries. Now, if I took this line here, which we'll call the floating value axis, and I'm straightening this out, if I pull this completely straight and made it linear, then that gives us our value charts price window below here in this window. Now, the second thing I'll point out is that we have what's called dynamic volatility units over here to the right. These are not the same units as the chart above. These are dollars per share for the chart above for the stock. These are units below with value charts designed to adapt to changing market volatility. If a market becomes more volatile, these units will expand with increasing volatility, and they will contract with decreasing volatility. We have to have that as a very important ingredient in the value charts price window in order for us to define overvalued and undervalued price situations. Okay. Secondly, we organize, or I've designed value charts to be very easy to read, and I've used basic statistics to do that. So you don't have to know anything about that. This is the science behind the indicator, but essentially the fair value or green area is where the market trades about 68% of the time, call it. Okay, this is the plus or minus 1 standard deviation. Moderately overvalued, the upper yellow, is +1 to +2 standard deviation in prices. Significantly overvalued is +2 and beyond to the upside. Now moderately undervalued, excuse me, below is -1 to -2 standard deviations. That's bottom yellow below the green, and at the very bottom here, -2 and beyond. So you don't need to care about standard deviations. You don't have to care about statistics. None of us really know the science that went into the fuel-air ratio in our engines or the cars we drive every day. I'm just showing you a little bit of the idea or logic that goes in behind this. Okay. Okay. So George, you should. Can everybody see my charts here? Hopefully they can. It should say statistics are used to define value charts. Sometimes, for whatever strange reason, most people can see them. If you are seeing this hung up, then your GoToWebinar has frozen. Log out and log back in, and that should fix it. So again, this is just the 5 primary valuation zones here associated with any value charts price window. Very easily organized. Once you understand these colors, once you understand these valuation zones, this is easy to see. Okay. Okay. Somebody, Tracy, you logged in, log back out, log back in. Excellent. You're good. Again, whatever strange reason, GoToWebinar freezes up for certain individuals and not everybody. So I don't understand how that works, but if you log back out, log back in, that usually fixes the problem. Now, reducing risk with drill down analysis. This is really what we're after at the end of the day when this is all said and done. We want to reduce risk. We want to get in, and in a perfect world, when I'm a buyer, I want to have or experience unrealized profits as quickly as possible after trade inception. All right. Now, what most of the world ends up doing is that they'll do their fundamental analysis. They'll say, okay, I've decided I want to buy Apple Computer. And then what they do is they go buy Apple Computer. Now, let me tell you why this is not a good thing to do. All right. If you go out and decide you're going to buy let's say a 2010 Mercedes CLK AMG, all right, 550 AMG. If you decide you're going to buy that car, do you go out and buy the first one you run across? No, you do not, because that's a recipe for getting ripped off. Same thing applies to the markets. If you've decided longer term you want to buy a stock or buy a commodity or futures contract or a Forex contract, you don't just go out and buy the first price that's thrown at you. This is where your timing element comes in. This is equivalent to going out and price shopping for a used car or for a house, for that matter. So this is very, very important. But most traders, interestingly enough, they don't do that. Most long-term investors will decide on the stock they want to buy, and a lot of times they'll just go out and buy it. Well, again, that's the recipe for getting ripped off, for buying overvalued, and we don't want to do that here. We want to enter markets strategically, again, so we can buy at the best, on the right side of value, right side of momentum, etc. Okay, what is the period of a simple moving average on the chart? It can change. So for the value charts, you can have a different focus or analysis period for value charts ranging from 5 bars back, very short term, to 50 bars back, much longer term. Now, can I show you a trading example of entering a long-term trade on weekly analysis with less than 2 ticks of risk? Now, if I'm looking at a weekly bar chart, probably not. That's very, very difficult to do, but can I use this for drill down analysis? Let's take a look at an example. Longer term analysis, that's step 1. Looking at a price chart, this is my cost analysis here, first component of technical analysis. I see that I'm trading, and this is right below this red arrow here, right up against a major long-term weekly trend line. All right, so step 1, I've got major resistance overhead, and I now bearish this market. Okay. let's see here. Now, excuse me, step 2, I'm drilling down. So this is step 1 again, to zoom in of the weekly. So I see my weekly chart was right up against, and I'm talking about the time period where the price was touching the trend line. That is my step 1, right around there. But even on a weekly chart, this could be 10 to 20 ticks of leeway, right, with my trend line. So now I want to look for setups on shorter term time frames. I'm drilling down. Now, I use this as an example because this is a situation I pointed out before, during when it was actually happening, as a drill down example when I gave my Federal Reserve workshop in late December. So this huge up bar here at the very top, this was live. The future bars after that had not happened yet. Let me show you the analysis that I used. This is a daily price bar. This is actually a chart showing me all 3 components of price. I have on the top my open, high, low, close price bars. I have an overlay tool called value bars, and then I also have my momentum tool on the bottom. All 3 of these were showing me that, giving me bearish signals. First and foremost, my value bars up here traded in the upper red zone. I know that historically that happens less than 2% of the time. The market rejected that, so pushed back prices back down. I also penetrated an old high here, several old highs in price, and cleaned out all the buy stops. Market, again, was sold right back off, came back down into moderately overvalued and then fair value. At the same time, you can see my momentum is slowing. So I have point number 1 here with higher momentum, point number 2 here with lower momentum, and this gives me a bearish divergence with price and momentum. So a couple things happening here, and all of them are telling me that this could be a bearish situation. So what do I do from here? All right, let's drill down yet again. Okay, just 1 second here. Sometimes when I back out of my my drawing tool, it backs me out of my screenshot. So I'm going to advance here. Everybody should see step 3. Look for setups on intraday time frames. Drill down again. So I'm actually drilling down twice. All right. Can you tell me when where I can listen to the recording? Yeah, Fred, we'll send this out. So we're going to send the recording out to you, and after this, so you should receive an email, and it'll tell you where to find it. Okay, now, okay, can you put a current example such as Google? Actually, Steve, I don't know if I'm going to have time to go over current examples in the markets, but there are lots of them out there. I just wanted to make sure we have time to cover all the slide examples I have here. So this is just an example in the past, but this is very valid. Again, same. We show these examples every day in our live trading room, by the way, or both of them. So for futures and Forex, and with Thomas Wood and David Kino shows stocks and options every day. So these are things we look for every day with drilling down with confluent strategies. Now here's where this thing drilled down into the 240-minute price time frame, and I have another confluence of different indicators: price, value with value bars, and momentum. Momentum again is slowing from point 1 here to point 2 with my red arrow. So I have a bearish momentum situation. I don't have a bearish divergence, but I definitely have a weakening upside momentum. And then I have prices trade significantly overvalued on the secondary bounce. Okay, that's where the potential for a very low risk entry comes in. The very tip of my 240-minute price bar pokes up into significantly overvalued. So let me recap. I have a weekly bar chart that's up against a trend line. I have a daily bar chart that was flashing over here, very bearish signals. I have my secondary bounce here, okay, drilling down into 240s. I have a weakening momentum picture in the 240-minute charts, and then I trade up to the red tip here in my price bars with value bars into significantly overvalued, which again we know happens less than 2% of the time historically. Now over here we can clearly see that when it traded up into red, it didn't stop. It pushed way up. This is a value migration. Not unusual. Important to understand the context of previous highs here. We should expect that oftentimes of the market to run all the stops. So this is why I use drill down analysis. The dailies were flashing bearish. A day later here, I had my 240-minute signal. This is where you can get the very high precision, low risk entry potential. All right, with all those things happening at once, literally 1.5 pips or ticks from the high of this using the extreme value as an entry. That's the kind of potential you have when you combine value, momentum, and price together. More examples. Let me see if I have any questions here. So does the confluence only occur on intraday time frame? No, you can use this at longer term too, Chris. You can use even monthly charts with weekly, monthly charts with daily. I'm just showing you one example where I had weekly charts plus daily technical analysis. So weekly technical analysis with major resistance, daily with price, value, or cost, value, and momentum, and then drilling down yet again to 240 using cost, value, and momentum again a second time. So using all these things together, it just gave me a very strong forecast, a bearish picture for the euro. And I actually spoke about that before it happened at the Fed webinar at the end of December, just to give you an idea. So I'm not cheating here per se by saying that's what I would have said. I called that out when it was happening on the weeklies and dailies, and then the 240 happened literally a day later. So let's go ahead and look at some other examples in stocks here. This is with Apple. Okay, because the short-term time frame with MQ momentum was divergent. Yes, on the dailies it was divergent. Okay, I use value charts, but how do you use the market scanner tool? Dan, that's actually a question for a different webinar. I'll try to do a workshop on that, though. It's a good question. We have customer service, too, that can help you if you have the value chart scanner tool in there. And I'll show you how to do that in another webinar here. So how can we buy at these lows is the question. And how is that even possible? If you're a price action trader, you don't know. These lows don't have any special significance because you don't have X-ray value vision. The goal here, again, is longer-term analysis. Once I throw up my value bars, again, and use my MQ momentum here at the bottom, then I have the opportunity to identify what I call significantly undervalued price points. Right? So now I identify those. Let's look for a couple of those that actually agree with momentum. So this one right here is the first one I'd point out, and this one is the second one that have probably the strongest momentum picture, bullish momentum picture. Again, first point right here, momentum picture right here, strengthening, point number 1, point number 2, and then again strengthening here to point number 3. So that momentum picture strengthening here, and then I have significantly undervalued price activity on the weekly charts. So let me go ahead and just use an example of how I can drill in there and show you an example. Now, here's the thing we need to remember. I'm pulling up our Bloomberg tool here. You don't need to have all this stuff on your computer to use this. This is just showing you an example of the science behind this. So for the second correction here, when we had, again, confirming momentum on the weekly basis, we know less than that our price is trading under that red area or within the bottom red area we call significantly undervalued right here. We know that, I'm pointing this right here, hard to see my red against red, but if we look over here on the price action profile, which measures the degree that a market's overvalued or undervalued, we know that the market trades less than 1.6% of the time in the significantly undervalued area. So that's important information for us. So right down here, the price action profile, that's the frequency histogram of price bars trading within the value charts price window, and again can measure the degree that prices trade above or below a certain value charts level. We know that underneath 8 trades 1.6% of the time. Taking that information, look for setups on shorter term time frames, and I'm pulling up a 60-minute chart here. For that situation, we can see that we had an ultimate low here, and we started to see momentum improving, so we could have conceivably jumped in here. So my momentum indicator here at the previous low, even over here at point number 1 or point number 1, and then point number 2 here, I have a strengthening momentum picture, and I have a strengthening of the histogram too with the MQ momentum indicator as well. So that significantly undervalued right there. I have a red tip doji very close to that, which is a value candlestick on the 60 minutes. And then all these undervalued increasing momentum entries here you see in the green, those are all being confirmed with my momentum. Higher low, higher low, higher low, higher low, momentum all the way up. So those are all very strong potential buy signals. And you can see they're very, very strategic. I'm risking literally on the 60-minute Apple chart over the days that follow my weekly significantly undervalued point, these bottom yellow price bar segments, you can barely see right there, these are where I want to look to get in. Okay, little dips a little farther there, but still very strategic entries here, combining value, combining momentum, and drill down analysis. Okay, I can't see where you're pointing at all. Fred, this is these are a little hard to see, but look at the different colors of the price bar. This is a value bars indicator, and I'll show you some more that are drilled in a little bit more here in a second. But the lower yellow and lower red price bar segments, okay, combined with my momentum picture, I have higher indicator momentum values. This blue line right here is strengthening. That's showing a bullish picture for prices on a 60-minute basis. And when the price bars themselves, with the yellow below the green or red below the green, indicates moderately or significantly undervalued. That's what I'm looking at on a drill down basis. Let's talk about the weekly chart. Yeah, so the weekly chart here, let's go back and just answer your question. The weekly chart over here has the bottom red. That's what I'm looking at. Significantly undervalued, bottom red bar intervals there. The second one has the very bottom red tip there. Okay, that is red. That's our starting point. And then we're taking that and we're drilling down to the 60-minute, and we're looking for strategic entries after that. Okay, yeah, John, thanks for coming today. Do you have a divergence to trade the dips? Yes, this is not a divergence, okay, but we do. For this first entry here with the big green arrow, that is a bullish divergence with the momentum indicator. I have lower prices, significantly and moderately undervalued, increasing, strengthening momentum. All this together on a 60-minute basis forms that. Do you have a moving arrow? No, we do have some flags, some value flags that point out value, undervalued or overvalued conditions, but we don't currently have a divergence tool per se. We can try to create one if that's something that you want us to work on. Now, let me get going here, otherwise I'm not going to have time to finish. Measuring entry quality. Now, one of the tools I like to do this is called profit bars. It's one of our indicators we have on Bloomberg. And the idea here is, let's say I'm shorting this position up here. I have confirmation with momentum falling off dramatically between point number 1 and point number 2, and then point number 3 again. Okay, so really weakening, consecutively, consecutive peaks with weakening momentum here, and then I have an overvalued situation on daily S&P 500. So if I enter a short position there, you can see that my goal is to have profitability, and prices need to sell off for me to be in that position. So if looking out about 10 bars here, if I sold this first blue bar here where my flag is up here, this illuminated price bar flag here, then this is profit bar flag, then after that I want to see prices fall below this red level, which is my entry level on the profit bars window, and turn green. Green is good because that means I'm actually profitable on my short position. So you don't need to have this profit bars tool to understand what I'm talking about here. The idea is you want to experience unrealized profits as soon as possible after trade entry. And sometimes you can get very strategic entry points. This is an Apple daily example with profit bars. Literally, I have 0% unprofitable in my daily bars that follow my entry point. That's the ideal situation. Doesn't always happen. In fact, most of the time it does not happen, but it can happen sometimes as well. So I've had many trades where I put it on and right away, because I've been strategic with value and momentum and price or a combination thereof, I can achieve a profitable situation very close to trade inception. This is an example on the buy side. You'll see right here my profit bar flag, buying significantly undervalued with Apple Computer. And you can see right here the blue bar is the entry bar, and then the red bar segments and the profit bars area over here is unprofitable trading action. But very shortly thereafter, 96% of my price bars after inception for the following 10 bars are profitable. That's what I'm after. That's what I'm talking about with strategic entry. So trade entry confluence strategies. Let me just talk about some of these in general. You don't have to have, by the way, the MQ momentum per se. That's my favorite momentum tool, but you can use MACD. You can use something else as well, stochastic oscillator and things like that. And I'll show you some examples of those. This is a great example of price, value, and momentum working together. So point number 1 here, momentum's dying off here, or falling, weakening, and point number 2, and then point number 3, and then point number 4, right in a row. A couple of these peaks, momentum just continues to weaken. and we combine that with significantly overvalued or moderately overvalued prices up here. So upper yellow price bar segments up here communicate moderately overvalued prices, typically identify the top 16% of price bar action. I also have what's called a red or yellow hat doji right there, which is a very bearish formation. In the context of weakening momentum, it's a great entry. Second example here, this is corresponding with number 3 here, second down arrow, moderately overvalued prices, weakening momentum. Again, you see a very nice follow through to the downside. And the third example right here, third arrow, moderately overvalued, again, weakening momentum. That's actually what we call a no return setup. So this is where the histogram bars on the MQ momentum indicator remain red. They don't even turn green like they did right here or right here. I'm using red. I should use another color here to highlight that. But the idea here is that you have red histogram bars and overvalued price conditions. Those can be extremely strategic entry points in the market. Now, this was a trade I took back, I think it was back after a government report. I forgot what they were trying to decide. They were trying to avoid some sort of disaster. But what I did here is I actually got out of a systematic trade up here and shorted this because I wanted to take profits because my picture was starting to look bearish. So I bought a couple contracts of S&P 500 December version and a contract, and then it rallied up here, and then I exited significantly overvalued, and I had a weakening momentum picture, and I also initiated a short position. So and that became profitable. Market snapped back. It was overvalued, had a worsening momentum picture again, slightly lower here on the indicator line, very much lower on the histogram line here. Bearish divergence, higher prices, lower indicator reading, and significantly overvalued, moderately overvalued price points up here. So those together combined created a bearish picture where I got out of my long position and also initiated a short position. So that ended up being a nice trade there. A great example here, what we call no return in soybeans on a daily basis. I have weakening momentum here between 1 and 2. My indicator line's going down. Down here, my histogram bars are red, and I have a moderately overvalued price bar segment up here on the correction. Very strategic entry point. If you're just a price action trader, you're not going to see all this happen together. So, I mean, price bar traders or price action traders can do very well for themselves, but you're leaving a lot of money on the table because you cannot see the no return setups like this one. Okay, let me answer just a few quick questions. Can we use drill down analysis if I use a 3 to trade? Yeah, you can, Chris. Exactly right. That's the idea. So these are daily examples of setups. Then that's exactly what I would do. I would go intraday, look at 60-minute, look at 30-minute, look at tick charts, and fine-tune your entry from there. Absolutely. Okay, scale out, take realized profits as soon as possible after trade inception. Well, in this case, Jim, for my, you can do a number of things here. One of the very powerful ways to trade with objective market valuation, let's say we shorted beans up here, as soon as we get moderately undervalued, this is called value target or value range trading. I can take part of my profits if I want to. It really depends on my long-term analysis. This was where I was actually bearish soybeans. So my long-term analysis was turning bearish. I had a yellow hat doji on a daily basis up here at the top, and then confirming weakening momentum. Great no return right here. So you can use value targets to get out of all or part of your trades if you want to. If I got put a trade on like the S&P where the market's significantly overvalued and I have a bearish divergence, I'm usually looking to take part of my profits at a minimum. All right. Okay. Let's see. Do I look at the color? Okay. Do I look at color only, red or green? Is the height of the bar in the histogram important? No. The height of the bar is not necessarily important. I'm looking at the color here, and the color is communicating one of 5 primary valuation zones that I reviewed earlier on in the presentation. Okay. Let me go ahead and zip through this, otherwise I will not finish today. So more examples here. We have our bullish divergence, lower prices, moderately undervalued, strengthening momentum picture here on the histogram. Those can be very valid setup, and then we want to drill down into daily. This is just looking at some general ideas. This is an MQ trend index tool that we use. Again, I have a strengthening trend picture with the cyclical nature of what's happening. The green arrow here, moderately undervalued. On the 240-minute bars, I can drill down to 5-minute, 15-minute for a more strategic entry. This is a good example of the upside trend picture weakening here. and moderately overvalued entry points, very strategic for these sell arrows right here. Again, strengthening downside here in the indicator, moderately undervalued. I shoot up to moderately overvalued. That's the upper yellow bar segments. That can be a value target. Over here is a great no return with the MQ trend. So I've got a sell right here. I can recover, enter, or exit at the value target down here at the second blue or green arrow here, and then I have a strengthening picture with my MQ trend. I'm not trying to go through these examples too quickly here, but just showing you some different ways to apply this type of methodology. Okay, so again, weakening picture, MQ trend index, moderately overvalued price bar situation, very strategic shorting entry right here, and then the opposite entry point over here. This is a slight bullish divergence. I have lower prices slightly below the previous low, and then I have a strengthening MQ trend index from compared from point number 1 and point number 2. So this is point number 1, point number 2, strengthening picture here, moderately undervalued in the secondary point, looking to looking to buy it. Yeah, MQ strength trend index is a trend indicator, but I have a very short-term reading it, so I'm actually using it as a divergence tool, so showing the impulse wave strength or weakness in the market. This is a good example of how you can use Bollinger Bands. I use one standard deviation here and then use MACD. So if MACD is strengthening here, like a higher low or an equivalent low, and I'm undervalued and I'm beyond the one standard deviation Bollinger Band lines, those can be very strategic entry points as well. So two long entries, one short entry, and I can get out at the value target equal and opposite. So if I'm getting in at the upper yellow here, once it trades down here to the lower yellow, moderately undervalued, I can do the same thing. Great entry signal here where I'm over the top Bollinger Band, and then I see a weakening picture in MACD here, and then I'm moderately overvalued with this last trade arrow. Okay, more examples here. I have a strengthening picture with MQ momentum, first buy arrow below the lower Bollinger Band, and then up here, weakening picture here in MQ momentum, and then I have a moderately overvalued upper yellow, and then above the Bollinger Band. So you can see how this works, just different tools to use different situations. This is a stochastic oscillator example here. I could have bought significantly undervalued. That's actually almost a hammer situation or a doji situation here in the value chart or the value bar. I have moderately undervalued value charts price window, and you can see my profit bar shows that if we would have bought in this situation with strengthening stochastic oscillator as well, that we had a nice picture where we achieved unrealized profits right out of the gate on this chart. MACD, I am using default values. Bollinger Bands, I am using one standard deviation in this example. You can use two, and it works really well as well. Again, weakening MACD picture here. This is the first one. I don't see a super strong value flag, so this one's not a signal. This first one right here. These value flags over here are. You see how the MACD is weakening between these highs, and then the secondary correction here. All three of these could have been right at the upper yellow bar segments, could have been potential nice shorting opportunities. Same idea here, S&P 500, 60-minute, weakening. You can see MACD, and then moderately overvalued right here as well, different picture. And we can see that as this sells off, we are getting an improved picture for our profitability. Here's a nice one. We have a red tip doji combined with increasing or strengthening stochastic oscillator. Point number 2, or green arrow number 2, is greater than green arrow number 1. I was significantly undervalued here, and my profit bars over here shows that even the very tip of that trade bouncing back was profitable right out of the gate. So these are the most powerful tools that I know of to find strategic trade entries in the markets. Let me go ahead and just close out here by saying, if your chart analysis does not have price, value, and momentum, then you don't have the complete picture of what's happening in a market. Now, here's what I'm doing. I'm going to actually break out the value charts indicator in our $1,000 core bundle and offer that today for $97. All right, if you're interested in that, this again is a very powerful value component tool we've developed across a number of platforms, including TradeStation, including, let me go ahead and pull up excuse me here, pull up the question box here and post this for everybody. Chris, thank you very much for your compliment. I'm glad you enjoyed it today. I'm going to post this for all, valuecharts.com/chart. So again, right up here at the top, go to valuecharts.com/chart. We've developed this for TradeStation, NinjaTrader, multi-charts, eSignal. eSignal's got a different format. We're limited on what we can do there with the value chart indicator, but it gives you some of the same information. Thinkorswim, etc. So those primary platforms we developed the value charts tool for, and you don't have to pay the $1,000 to get this. You can get this now broken out by itself for a limited time at $97 price, and this will be a good chance for you to kick the tires and see how you can use the value charts indicator along with momentum, along with your analysis and price, etc. It does, Steve, we do have that on TOS as well. So check it out. And the appearances, by the way, will be slightly different. TradeStation has the colored bars, and TOS has the colored bands. I think Ninja does as well, and then so on and so forth. So we also have it for, we've developed that for Sierra charts as well. Okay, so again, go to www.valuecharts.com/chart. Now, we do have another speaker this morning, so I am out of time. Hopefully I answered some of your questions, but Larry Gaines has some great content coming up here. I do not want to eat into his time. Larry, welcome. Let me tell you a little bit about what he's going to talk about. He's going to talk about key factors on embracing risk and avoiding the newbie option trader mistakes, most important option factor for income generation, properly pricing the option you want to trade, and specific income strategies for every market. And Larry is CEO and founder of the Power Cycle Trading. That's at powercycletrading.com. And he's got a great experience going back with he's been head of an international trading company that traded literally billions of dollars worth of commodities in a single day. So he's a player. He has a great experience, and we appreciate, Larry, you coming and joining us today.
Hey, thanks a lot, Mark.
So I'm going to give you control here.
Yeah, thank you.
Here. You bet. Larry, again, we're excited to hear what you have to say. I'm going to go ahead and mute myself, and you are now showing your screen.
Thanks. Let me get away from that screen. That's pretty ugly, isn't it?
Well, looks like you keep yourself busy there.
Yeah, a lot of clutter. Let me see.
Okay. But by the way, Dan, I'm going to answer your question. Is there a monthly cost? No. These are all purchase prices, by the way, for the indicator I was just throwing up there. They're one-time costs, so there's not monthly fees with our indicators. We sell them. You own them. Okay, Larry, you're off to the races. Thanks for presenting.
All right, thanks, Mark. Thank you, everyone, for being here today on a Saturday. That's wow. But it's a good way to get started for a Saturday. So I'm going to go over, today, just kind of be talking about risk and options and things like that. So let's get rolling. First off, the following webinar is purely educational purposes only. Any stocks or futures or options mentioned does not constitute advice and should not be construed as a recommendation. Just trying to get my mic fixed a little bit better. So basically, Mark gave you a little bit of my background. I've been actively trading for over 30 years. And I was previously executive vice president for one of the largest oil trading companies in the world and managed their trading desks, international trading desks out of Bermuda for over 10 years. So we were very active in all the markets. If it moved, we pretty much traded it. So it was a great experience, a great learning experience for me. Very privileged to have had that kind of opportunity. So it was fantastic and took really great advantage of it. So we were also one of the first groups to trade over-the-counter options on crude oil and traded millions of barrels of crude oil options. So that's kind of where I got my first taste for options, and that was back in the mid-'80s, and kind of got me addicted to it and obsessed with options ever since. Went on to launch the over-the-counter crude oil option desk for PVM Oil, the largest privately owned oil brokerage company in the world. Did that, and that was another great experience because it showed me all the intricate option type strategies, and we did lot of brokering between, hedge funds and institutions, banks, and things like that. So a lot of background there, and a lot of background with trading systems and everything there. So I know Mark, I was listening to his presentation. It's a really cool system that he's put together. So been involved in a lot of that kind of trading as well. But options is kind of what I really enjoy, and that's what I'm going to be really speaking with you guys here today. I always like to get a feel for everyone that is in one of my presentations. I like to kind of get a feel for, are you guys here looking to be full-time traders, and what are your intentions? But maybe put a yes or no if you're interested in trading full-time, but you're not quite there yet, or maybe your confidence isn't enough to go out for it on your own. I just kind of like to get a feel for everyone that's in the presentation. So if you just put a yes or no, that'd be really helpful. Well, actually, I can't see the questions, but I'm probably seeing a lot of yeses there. And I guess the point is that we all start someplace, and I can vividly remember when I went out on my own, just trading full time for my own account.
Hey Larry, I'm sorry to interrupt here. Can you see the questions now? Make sure you're set up here.
If you change me to organizer from panelist, then I'm able to see them.
Okay, how's that?
Great. Got it now. Thank you. Okay, super. Yeah, so when I went out on my own trading, it was a totally different situation. I mean, when it's not your own money, it's a hard thing sometimes to get used to. When I was running the international trading desk, I found myself in plenty of very nerve-wracking trading situations. But at the end of the day, it really didn't affect me personally. As long as I followed the owner of the company's his protocols and rules we had in place, he was okay with our trading losses. I mean, he knew that we're going to have losses. And believe me, we had some really ugly losses at time. And, it's never fun to lose, but you know what? It wasn't my money at risk at the end of the day. So it was the guy that I was running the desk for, the owner of the company, and he was, extremely wealthy. So it was a really different type of uncomfortable feeling when I took a loss from my own trading account. The other thing was that when I first started out trading my own account, my trading style at that time was different. When I was running a big trading desk, our trading style was very aggressive. We had a lot of capital, behind us at our disposal. So, we were kind of more of a big momentum type trader, and we were able to push the markets and use that to our trading advantage. So when I began trading my own account, I was kind of still caught up in that type of trading style, and trading money more like a hedge fund than for my own account. It was a totally different type of style that I needed to develop. So my trading drawdowns at first were much more stressful and painful because of the style of trading that I was doing when I first started. So I had to reevaluate everything I was doing and totally look at changing my trading style if I wanted to be successful and stay in the business. So now for my own account, it really improved trading once I learned how to better control risk. And the huge breakthrough really for me was learning how and committing to limiting my downside in any trade taken. And I did this, and I do this currently, by using option spreads. And the really big aha trading moment for me came when I started taking advantage of option premium collection type strategies in my own trading. Now once I committed to this, it became a totally different game. And I could sleep a lot better at night, and my equity curve started really getting a lot more smooth as far as the direction from left to right going up on a smoother angle. Now I really believe that probably 60 to 80% of a trader's success really comes from your emotions to the market. If you can, it really comes down to keeping in check those big time emotions that may surface from when you get fearful of the markets or greedy. But what I've found is that when you know the maximum loss you can incur based on your trade setup and you're okay with it, then these fears are going to be kind of relieved. And the really cool thing that is that when you use option strategies, it allows you to completely control your risk by using spread setups. So you can decide how much risk you're going to have, and then you structure your trade accordingly. So it's really that simple. So based on that, I just kind of want to give you my little background on me. And trading has its stressful times, but if you can understand what you're doing and you're in control of your risk, then it's going to make it a lot easier for you, and you'll be a lot more successful. So then the next thing is, ask yourself this: what if you could add a new stream of income? Would it change your life? And if the answer is yes, then you have a plan to achieve that goal. Well, I put together it's a simple plan. It's a 5-step option income success plan. And the first thing is to embrace risk for trading opportunities rather than avoiding risk. And then also number 2 is avoiding that number 1 option trading mistake, and we're going to go through that. And then what's the most important factor, option factor, that you really need to understand if you're going to do any type of option strategy or income strategy. And then another key thing is, how's an option priced, so you can take advantage of those components. And then we're going to cover some, option strategies that you can use for any type of market that are more income-oriented type option strategies. So first off, though, is, embrace risk for trading opportunities. And trading is really, about managing uncertainty. And the fear of uncertainty will really be an account killer. But if you're able to shift that approach to choosing to manage risk instead of uncertainty, you can really create an account winner. And then, the question is then, how is this done? Well, you want to have a simple trading plan to start out with. And it can be, 5 or 6, 7 steps. It doesn't have to be anything too intricate, but you need to have some rules in place. So first off, choose your risk limit. Then you want to be able to, you need to own accountability for your trading decisions. It's, up to you. You can't blame anybody else but yourself. And to do that, the best thing to do is then understand the risk with the strategies you choose to use, know how to defend any trades you enter within your chosen risk parameters, and choose those trades that have defined risks that meet your guidelines. You're in charge. And everybody will have a different capital account and different trading styles and guidelines. Nobody's going to be exactly the same. Everybody's going to have a different lifestyle as well. So you need to go through these and understand who you are and what your goals are. So set those out. Now the second step is to avoid what I call the number 1 option trading mistake. And option trading is great because it offers you many more advantages than trading stocks, but it's also a bit more complicated. And for the new option trader, it can be a little intimidating. And that's why many investors decide to begin trading options by buying short-term calls or puts, especially the out-of-the-money type calls where that strike price is above the current strike, above the current stock price. And since it's been kind of embedded into us all, over the years, buy low, sell high, this is, kind of the familiar pattern that everybody, starts out doing. So here's a simple example to illustrate this. So let's say you're bullish on Facebook and it's trading at $65. Now, as a beginning option trader, you might look and be tempted to buy calls 30 days from expiration with a strike of, say, $80. And those particular calls are going for 15 cents or $15 per option contract. When you look at that, you think, wow, you do the math and you think, man, that's incredible. I can really leverage up on that. Now remember, one option contract is kind of equals to 100 shares. So, when you go through the math, you can see that if I bought 100 shares of Facebook at 65, that would cost me about $6,500. But for that same amount of money, I could buy 433 contracts of those 80 calls, and that would control over 43,000 shares. And you're thinking, man, that is just incredible, and it is. The leverage that you can get off options is incredible, and when you start looking at it, you get really excited. And then you think, okay, Facebook hits 81 within 30 days, and that those 80 calls that I was buying at 15 cents or $15 are now worth 105. And then the dollar signs just start to register, and you're thinking, wow, that's over $38,000 in a month versus, that smaller investment of $6,500 or bigger investment and not getting as much leverage. So, at first glance, it looks really spectacular, and it is awesome. But the key thing here is don't get fooled by the glitter, and that happens with every option trader or every trader starting out. I can remember specifically when we first started getting into options back in the mid-'80s, when we were introduced to them by all the Wall Street companies. And we were intoxicated too by the huge leverage, and so we started out of the blocks a lot more aggressive and not knowing what we were doing, and we ended up losing a lot of money because of it by making those same newbie option trader mistakes that I'm talking about here, but on a bigger scale. So the one problem with short-term out-of-the-money calls is that you not only have to be right about the direction the stock moves, but you also have to be right about the timing. And those combinations really ratchet up the degree of difficulty. So, to make a profit, the stock doesn't just need to go past your strike price, but it also must do it within a defined period of time. So in the case of those 80 calls on Facebook, you need the stock to reach $80 within 30 days just to make your profit. Now you're asking that stock in this particular example to move more than 23% in less than a month, and this is in option terms on this example, this is like a 2 standard deviation move, and then you look back and you think, well, how many stocks are likely to do that? Well, they're not that many. I mean, we see them from time to time, but on a consistent basis, stocks are not going to move like that. So it's the higher probability is that the stock. Excuse me one second here. So the higher probability is that the stock, would not reach that strike price, and those options would expire worthless, and you lose your money. So, based on probability, and trading's all about, probability, right? Using standard deviations, which we use for, a lot of our statistics and options and all the trading. In this particular example, there's really only a 5% chance of this stock reaching $80 by expiration. So, in summary, in order to make money on an out-of-the-money call, which looks so attractive, you either need to outwit the market or really get plain lucky. And I've never been really that lucky, with trading. We used to have, there's an old blues song that says, and we used to say this in the trading room a lot, when you're having a bad day, if I had no bad luck, I'd have no luck at all. So that's the old saying that we would always say when things were going bad. So, being close means no cigar. And so you could also go back and then at that same stock, if it goes to $75 within 30 days of the option, you're saying to yourself, well, I got the direction right, but I still lost money. So it happens, and that's the thing that I want everybody to kind of take out of this today. So based on this newbie option trader mistake, really a better goal for every trader would be to select trades based on what provides the most consistent positive return. And one of the best ways to achieve this that I found is by using option strategies that take advantage of selling options for income generation. And then, how's this done and what's involved? Well, the first step and one of the most key components is time when you're selling, and to take advantage of the time value of the option. So in option speak, time value is for trading strategies that take advantage of that accelerated time decay of an option into its expiration. And option income strategies are, totally tied to time value and the impact that it has on that price of the option. So it's the key thing that you need to understand for this type of strategy. And so what is time value? Well, it's the, extrinsic value of the option. In option, it's the premium a rational investor would pay over its current exercise value, which is the intrinsic value based on its potential to increase in value before expiring. Now this probability is always greater than 0, thus the option is always worth more than its current exercise value. And then time decay, it really goes exponentially to 0. It starts to develop really fast. So the general rule, if you're not familiar with it, is that it will lose about 1/3 of its value during the first half of its life and 2/3 going into the second. So as the options move closer to expiration, moving its price requires really a bigger and increasingly larger move in the price of the underlying security. So, if you're not taking advantage of time decay you're going to be swimming against the current. And, you know, as a trader, you'd rather make it easier on yourself than harder. So by taking advantage of time decay and going with it, you know, it's going to create a lot better, easier trading setups for you. So here's a really good illustration to show you the chart of how time decay can work. Let me pull up a pen real quick. So, you know, when you're starting out 120 days out or 90, it's very slow. So we measure time decay in options by theta. And the other cool thing about options is you have all these free option tools for any brokerage platform, you know, Thinkorswim, TradeStation. So you have all these free tools that you can actually, you know, use to see what the value of your trades will be. And so you can look at theta decay, and it's real slow as from a further out time point. And then as you get in closer, you know, that 30 days out, that's when it really accelerates. And then the weeklies, you know, are time decay on steroids. So it really falls off fast. So you need to be aware of that. And as a trader, you take it and use it to your advantage, you know. So here's another example of the time decay on ultra steroids. This is your weekly curve, and they come out, weeklies, if you're not familiar, come out every Thursday, and they expire the following Friday, or Friday 8 days later. So basically each day it's decaying by 1/8 or 12%. And so, you know, if the market's going nowhere, you're losing money fast on those weeklies. So, you know, take advantage of that as a trader. And to do that, you can do it with these option selling type strategies. So then the step 4 is then, well, how does option pricing work? You know, so you need to kind of understand the basics of that to know what components that you need to, you know, to be aware of and how to use those components to your favor. So basically, the value of an option is just determined by time value times its implied volatility times that intrinsic extrinsic value. And once you know these variables, then you're, you know, ready to price that option and know what that option premium should be. And the other cool thing with options in your platform is that you've got all these like free tools. Like I said, you've got, you know, the theoretical values. You can plug in, you know, different dates. You can plug in different prices, so you can see what the price of that option might be. And that's, you know, there's just so much to it. The other thing that I love about options is as we get older, you know, I don't know about you guys, I don't have a whole lot of hobbies. I'm like a kind of a, you know, trading is kind of my passion. I'm a kind of a workaholic. But, you know, I, you know, played some golf and stuff like that. But I tend to kind of migrate back more to trading and the stimulation that it gives me mentally. So options is a real mental type thing that really I loved reading about it and, you know, researching and all that stuff. So it really drives me. But that's just kind of a side note just about me personally. And then the other components, though, of that pricing is implied volatility. And it's what the marketplace is implying the volatility of that stock to be in the future. And this is the key part, based on the price change in the option. And usually, and it's based on what's going on currently. So when you have a big spike down like we had on Thursday, that jacks up the implied volatility. And then, you know, that's a one-day event. And you can see yesterday, then prices went back up. So, you know, if you can take advantage of that one-day event, which happens usually when these spikes happen, they're only for a few days. And if you know that as a trader, then you take that to your advantage. And when that implied volatility spikes, it creates that bigger premium. And then that's a great time to sell, which I'll show you in a minute. So then the other component then again is that intrinsic value, and that's the amount the option is in the money. And then that extrinsic value is, you know, the amount that that it's out of the money. So these are the three really basic things that you need to be looking at for pricing that option. Now here's a kind of a table to show you how those relationships affect one another. So here's your time value times implied volatility here times the intrinsic extrinsic value, and that equals your option price or your premium. So here I just kept that intrinsic extrinsic constant right at 1 so we can fiddle around with these numbers. And then on this is a weekly. So on Thursday, that option came out and had 100% time in it. The next day, it goes down by 1/8, and you can see that then that implied volatility stayed the same at 300. I had it here. you can see that the price goes down on that option because of the time decay. Now when you come into Monday, the thing is really starting to decay. You know, it's about half of its life is gone, and you implied volatility really jumps up that day to 800. I put it up there so you can see the difference. But look, the premium, you know, barely goes up, and that's because of that time decay. So it's a key component, and if you can take advantage of that in your trading, that it just gives you another really good benefit for, you know, your trading options versus just flat price a lot of times. So the fifth step then is selecting the right income strategy. And again, the goal of every trader should be to select trades based on what provides the most consistent positive returns. That's the way I look at it, because I want that smoother, you know, equity curve, you know, something that's smooth like this rather than going up and down, up and down. I mean, that gives me jitters and nightmares and can't sleep, and it's hard on my bank account too for the drawdown. So with income option strategies, combine that with some of your other trading strategies, you can get the smoother type of progression on your account. Now I will combine this with directional trades as well. And that's the other thing. It's a higher probability type trade, so you can diversify your risk that way. So it's another good example. But you know, getting back to this, one of the best ways to achieve this is by knowing the income option strategies that are available to you, and then selecting the one that's best for your trading style, your lifestyle, and your trading plan. So the basic income strategies are covered calls, which you've probably heard about, calendar spreads, diagonal spreads, long iron condors, and credit spreads. So we're just going to touch on each one of these, and you kind of get a feel for it. Some might be more appealing than others to you. And towards the end, my favorite, though, is the credit spread, and we'll cover that towards the end. Strategy one is the covered calls and puts. And for monthly income, you know, writing stock options is the basic component. When you write a stock option, that premium from the sale goes right into your bank account, and that's the cool thing. You know, you sell an option, you get that premium, it goes in your account. So you keep that premium regardless of what the stock or option does. Now I tell my clients and my traders in my trading room that the easy part is selling the premium, you know, and putting it in your bank account. The hard part is keeping it. So that's the thing that, you know, you have to learn, and that's, you know, some of the things that I teach. And then, you know, when you look at stock options and then you look at the compounding effect and the wealth that can build, that's another really big aha. So the cash, you know, from writing stock options can be compounded really into great wealth. You know, and if you understand the power of compounding, you know that if you could take a small gain, a 5% gain every month, which is not a small gain in our current environment, but if you could, and you can do this, if you can take a 5% gain each month, you know that can make you rich, and you can see that from the incredible wealth building power from compounding. Now most investors and traders will overlook the wealth building power of the compounding and simply purchase, you know, stocks or futures with the hope that it's going to increase in value. Now, you know, while stock option writers, though, they have increased their returns significantly, you know, by writing options. The traditional investor is still out there waiting and hoping for that big upward stock price movement. So I don't know about you guys, but back in 2000 and 2007 and 8, while I was trading and managing money for others, I had my money managed by some people that I thought were really good money managers, and I lost a heck of a lot of money because they didn't do what they should have done, or they couldn't do what they should have done. Because when you're managing billions, like, you know, some of these institutions, these money funds for other people, they can't turn that ship around on a dime. So you imagine trying to get out of billions of dollars in one day, you just can't do it. So this is the thing about, you know, being in control a lot of times of your own money and taking responsibility for it. You can do it because, you know, you can make the decisions a lot faster and move faster. But if you go back to this example, if you just had your IRA and you were able to make 5% gain, and you start out with $978 in a 10-year period, you can grow that 5% compounded to $340. So that just shows you the example. Same thing if you had that's just sitting in a yielding 2% interest, you know, it'll take you over 100 years. So by understanding the benefits of income option strategies, it helps you look at a different way to trade, and it's another really fascinating thing to add to your trading or investing. Now, covered calls versus puts. Now, if the market is strong, you want to write covered call options, and you're going to treat the stock as a commodity traded just to generate that monthly income, just like if you're on your rental properties. You're not really looking for the upward appreciation of that rental property. That's just an added bonus, but you want that monthly income. So it's not important to want that to own that stock the options are written against. It's more important that that stock goes up if you're writing a covered call and having that stock called away. If that happens, you know that you're successful and you're going to keep that income. So it's important you like the stock, short-term potential, and to select the stocks that are going up. But you don't have to fall in love with the stock. The stock is just, like I said, it's just really a commodity for you to collect income against. So writing stock covered call options, it's great when the income when the stock market is going up. But what about those times when the stock market is falling off that cliff and going down? Well, there are a couple things you can do then. You can do what we call covered put options. So your writing stock covered put options allows you to profit from a declining stock market. So with the stock covered put option, you've already sold the stock short, so you don't really care if it drops sharply. The other option income strategy to use in a weak market is to write covered call options on inverse funds or bear market ETFs, and this is my preferred way to do it. And it's just the same concept. So there are a lot of different inverse ETFs, and here's just a list of a few that I like to use. For the QQQ, you've got the PSQ. The one I really like is I like to lever these things up. So but I understand the leverage, and I understand the setups, because that's what I do. But I really like this Ultra QQQ, the QID. The SDS is a really good one for the S&P 500. Very, very tight spreads, liquid. And then a really great one for the Russell 2000, which the Russell is the really big one too, because the markets are usually going to be led quickly up and down by the Russell, because it's got all the small cap, high beta type stocks, and they're more volatile. So that volatility creates really good opportunity. So that's the TWM. So you can use these inverse type of ETFs, just buy these long as the underlying, and then sell calls against them. It works great in a down market. Strategy 2 is the calendar spread. And this is a pretty cool little strategy. The calendar spread is a neutral option strategy that allows profits when the underlying stock remains stagnant or trades within a tight range. Now, calendar call spread profits primarily from the difference in the rate of premium decay that we talked about between that near-term short option, the option that you're going to be short, and the long-term option that you're long. So it's a timing spread. And a lot of times you can use the leap options, which are the longer-term options that are out a year or even 2 years. And this is possible as the near-term option premiums, remember, decay a lot faster than the long-term premiums. So this is the way the spread is constructed. So basically what you're doing here is, let's say Microsoft is trading at $30 or something like that. So you go out 60 days out and you buy the $30 call, so you're long that, and then you're going to short the same $30 call 30 days sooner, or 15, or whatever. And then the spread between these two, you're looking for that time decay, and you're making your money off that premium that you shorted and that decay, and keeping that premium, versus the long option that has that really tiny small theta decay. So this is a good strategy for when the markets are a little bit more sideways. You don't want this strategy obviously if the market's going down. And this is also a good strategy sometimes when you want to bank a stock, so you think that the stock's longer term opportunity is there, but it's not quite ready to move. So you can do this strategy, collect a little income on it while you wait for the stock to eventually go up. So it's a nice little strategy. to know about and to use. Now the third one is the diagonal spread, and this is a version of the calendar call spread or calendar spread, and all you have to do is purchase an in the money leap. Okay, that's that long-term option, and then sell an at the money or out of the money call or put, whatever you're doing against it. So it's basically just kind of exactly like a covered call, but you're replacing that underlying stock with a longer-term option that's maybe way out there, which has very little time decay. And so this is an example of a trade that I did earlier in the year. This was USO, which is the ETF for crude oil. And the USO was trading at that time at $35. And so, this example bought 10 contracts of the USO. And this was in January 2014. So bought the 2015 25 calls, roughly, this is plus or minus, at $10. Okay? And so the at the money USO 2014 then sold the April 2014 35 calls against it. So USO was trading at 35. I bought the 25 calls, sold the 35 against it. So here's what it looks like. And this is a good strategy that I like when the markets are, coming off a hard bottom, flat, and then starting to cycle higher. You don't want to do this strategy when the market's already up here, hard, maybe consolidating sideways and looking for a next leg up, because if it does roll over, you're going to get hammered with that long leap. So this is the thing you have to be aware of. So I like this when the markets have been hit down hard. They're on what I call cycle low. So you can see here you sold that April 35 call against it. You collected $60. Okay, so you were long the January 2015 25 calls. Those cost you $10 or $1,000 per option contract. So you have that debit of $1,000 less the $60 that you collected. So you had $940 as your risk. Now, if the April 35 calls, if it closes below that at April, then you keep that $60 and your return is 6% off your capital at risk. Annualized, just for comparison, 72%. Now, if you did just a regular covered call on USO and you bought the $35 shares, 100 shares, to make it equivalent, you paid $3,500 there, 35 less your credit of 60 you received here. So you can see your capital at risk there is $3,440 based on 100 shares. And if the April option closed below that 35, you still keep your $60, but your return is based on a bigger capital portion, so your return is only 1.7%. So that's an example there. And then, you can do this particular trade. I ended up selling calls against it, I think, 3 times, and finally then USO took off, and I sold off my leap options for a profit as well. So, these are strategies to be aware of, and in certain situations are really great to incorporate in your trading. And so then the other strategies that I like, I like because there's so many different ways that you can use them, is the short vertical spreads or credit spreads. And there are really 3 basic ones. You've got the bear call credit spread. Oh, question, I see. What happens if it closes above 35? Well, a couple things. You buy back the short option, and then you leave the leap. You can sell another option against it, or you can exercise that leap that you're long. So because you're hedged, you're long, it's just like if you're long the stock. You can exercise that leap, but that has that time value component in it. So basically, you're going to want to, it's better just to buy back the option, keep that leap, and then sell the leap, keep that traded out. So, but the point is you're hedged through that trade. You're not naked short, So you've got that leap option that's there to use, if you get called out. So the other strategy is the short vertical spreads, which is the bear call credit spread, the bull put credit spread, and then you've got that long iron condor off that. So basically what they are, they're very simple actually. You're just on a bear call credit spread. This is a bearish strategy. You're just long one call while simultaneously short a call with a lower strike. So it looks, basically like this. So you're short, let's say, a $400 strike, and then you're long as your insurance. You can look at that as insurance, the $405 call above it. So, and then you collect, let's say you got $100 here, premium, collection. So that's the bear call credit spread. And then the bull put credit spread. This is a really great one. It's a bullish strategy. You're short one put while simultaneously long another put with a lower strike. So here, if the market's going up, you can, let's say you're short the 390 puts, and then you're long for your insurance the 385 puts below it. So you're protected if you're wrong and the market goes down. You're protected with that 385, and let's say you collect $100 there. So these are two premium collection strategies, one for a down market, one for an up market. And then basically the iron condor is just if you combine the two of these together where the markets are going sideways. So if you combine these two together, and as long as in this example the price closes above $390 and below $400 in this example, you can have these strikes a lot wider apart. Then you collect $200. You keep that 100 from the bear call spread, and you keep the 100 from the bull put credit spread, so your profit ends up being $200. So this is a really good strategy when you see the market in a sideways type trading action. So these are the ways to use those credit spreads, short-term vertical. Now, I just showed you the iron condor. Now here's, we'll go through an example here in a minute, but so the short vertical spreads or credit spreads, when used correctly, they provide the trader or investor, the greatest probability of success, and are one of the best ways to generate a steady stream of income monthly. And it's really because it's based on the math of probabilities, and trading is about probabilities, right? So here's a really good example to illustrate this. This is on Wynn Resorts. This was back May 1st, going into its earnings, and Wynn was trading at $206. So this is going to show you the comparison between a directional call, buying it outright for a bullish move up, versus a bull put credit spread, which is also for a bullish move up. So on this particular day, the 207 calls, Wynn was trading at 206.63. So you buy the at-the-money calls, they were 207. So those were 1140. So that's $1,140 per option contract. So that's a debit, and that's your capital at risk. Your profit is infinite down here, you can see, but your cost is $1,140 on that example. Now here's what happened on this trade to show you the difference between these two strategies and the benefit. So here's Wynn on the 1st of May. It's at $207. You bought that call, $1,140. Spiked straight up after those earnings. You're looking for this thing to keep trending, right? But what happens? It comes down. So on May 8th right here, Wynn is at about 195. So let's see what happens on that option that you bought, the directional option that you bought. So here's, in this slide, you'll see that on this day here, when Wynn falls down on May 8th to 195, you can see that option that you were long, the 207 strike, now you're in the hole $583 on your P&L. So, that went down fast, and you're down now in the hole $583. Now, on May 21st, here, Wynn comes back, it recovers, and now it's back at around 205. So it's only $2 down, but still, you're still down now, 518. You're a little bit better, but not that much. So you can see here, you've got to get that direction right, number one, plus you've got to get the time of the direction right for that option that you bought directionally to work out for you. Now, if you get that right, you'll make a tremendous amount of money with those directional options, but the probabilities sometimes go against you. Now here's the other example. This is if you did the bull put credit spread instead of just buying outright. So in this example here, if you did the bull put credit spread, you're selling the June monthly 187 puts, collected $513 per option contract, and your insurance premium was you bought the 182 below it at 333, not 313. So that credit spread you sold at a 9.5% below that May 1st price. That's one thing, so you've got some room there. And the other thing too is you set that credit spread below support at that time, which was 183. So you had a nice setup on that. Now by doing this, you collected $130 per contract right there, and your margin is the difference between the spread of $500. 187 minus 182 is 500. So your at risk is that margin of $370 which you put up. So your capital, your return will be based on that margin. So you've got a potential return here of 35% if you keep that $130. So that's what it looked like on May 1. Now let's go through this and see what it looked like on the next, May 7th or May, let's see, here's May 1st, and then we want to see what happens on May 8th. So May 8th, when that credit spread or when the market goes down on win, it's at $195 down here. Right here, you can see it crashed. That credit spread is only down minus $38 right here, see, P&L. But you're down, if you bought those directional options, you're down $583. So it's a huge difference. And that's the aha. That's an aha to me still, when you can incorporate these in the right situations. So that's what it looked like on May 8th. And then here's what it looks like on May 21st when the market climbs up. Now you're up $78 per contract, while that long call is still down $518. So it's a really great thing to look at, to incorporate. Now it's something that I like to combine the both together. I don't do just straight credit spreads all the time. I always like to do a basket of trades. So I'll do if the market's exploding up, I'll buy directional calls, but I'll also do the credit spreads with it and diversify my risk. Yeah, you could have bought puts, sure, but my bias, my system, my whatever was telling me this market's going to go up, not down, so I didn't want to buy puts. This is a long trade. I'm looking for a move to the upside, not to the downside. So this is an example to show you the difference there. Now, when I say it's all about the math, here's the thing. Here's a normal distribution curve. So real quick, when you're trading options, the probabilities are based on standard deviation. So typically, one standard deviation is 68.2%. And 68.2% of the time, the price of the underlying is going to close between one standard deviation. So if you can take advantage of that and know that, then it offers you some good opportunities. So you put the probabilities in your favor. So instead of buying those way out of the money options all the time, be aware of the probabilities, and that's using standard deviation, which is a whole subject matter in itself, but something that that I cover and teach. So basically what we were able to cover here today is how to embrace risk for trading opportunities, avoiding the #1 option trading mistake, most important option factor, how option pricing works, highest probability option strategy for every market. So I wanted to go through all that and then get into your questions. I'm seeing a lot of questions here, and I definitely want to get as many of those answered as possible, and I'll answer those in a few minutes. And I'd also like to tell you a little bit more about how you can also learn a lot more about trading credit spreads, defending credit spreads, and some of the other great option strategies. But I hope you all understand that there's only so much time that I can cover things here today without really fire hosing you guys. So I'd like to also first off say thanks for giving me this chance today to share some of my trading experience and knowledge with y'all. And I've been trading for over 30 years, and believe me, I've made plenty of painful trading mistakes. So hopefully what I've been able to share with you today is, in this very short period of time, will make a difference in your trading more profitably, because you can see some of these other things you can do, and it'll help you down the road. Now, I realize most of you don't know me at all, so I'd like to share with you an email that I received from one of my clients, Russell. If you can just take a couple minutes here, I'll let you read it. Just take a couple minutes there. This is one of my clients and members, and so if you look through here, you'll see that before he took my income course on options, he did not know how to defend credit spreads. And then I really liked the way he referenced that Swiss Army knife. That was really kind of cool, because it's the international symbol that really we all need to have something like that in our toolbox, right? So it's really an honor to know that I've made a difference in somebody's trading, and it's a great feeling. Now, next I'd like to talk, before I finish out here, is about some simple things that you can start doing now to generate a more steady stream of income each and every month, and also how you can learn to implement an option income stream. And hopefully this sounds appealing to you, and I'd like to go through some steps that you can take now to do it. So again, though, first off, though, the real aha trading moment for me that really shifted my trading was to start incorporating these credit spreads into my trading. So I really can't express enough the importance of using them. Try to combine them with what you're currently doing, and do a little research and start out small and do this and see if it helps your results. Now, I recently put together a special credit spread workshop to teach traders who are pretty much on any level how to use credit spreads in their trading. And here's what it incorporates. It's a 4-hour course that I did that was recorded, and it's a step-by-step course on credit spreads. And so what you get is you get all the recording, the modules, and then you get the 89-page PowerPoints, which I love, because these PowerPoints I use kind of as notes. So it's on demand, so you can keep going back until you get what you need out of the system. You get it down pat. It's 100% focused on option income strategies, and primarily credit spreads, iron condors, and it's all content and no hype. So here's the link for that. Let me put it in here so it's easier for you to cut and paste. So if you just go to powercycletrading.com/offer, this is a $97 course. Now, it's 97 bucks, which I mean, for the amount of content that's based on my 30 years of trading experience, it's a really good deal for you. And if it's not something that you can use and you're not getting anything out of it, I'll also give you your money back. But please just don't kick the tires. If you're interested in this, buy it. But the other thing too is, if you've never been involved in credit spreads, this gives you a really cheap way to learn about credit spreads. And this is what you're going to be covered. Now, one more thing too is that whenever I take a new course, which I've taken lots of courses over my career, and you always have a lot of questions. So the first 20 that register here today, I'm going to limit it to 20 because I want to keep it a small group. I'm going to also do a follow-up Q&A for this, accountability Q&A, which I call it, to make you accountable. Go in there and learn it, and then come and ask questions. So for the first 20 of you to do that, here it is for you. Now, this is what's going to be covered, and it's all content. This thing turned out to be 4 hours. It was supposed to be a 90-minute course, and I just kept going because there was so much I wanted to cover. So here's the link one more time. So you're going to learn how to use credit spreads to create low-risk, high-probability trades. It's all about probabilities. I teach you implied moves, how to calculate the probabilities, how to use standard deviations. That alone, learning standard deviations and the probabilities of trading is worth, this course right there. How to use credit spreads on stocks and index options. I like to use credit spreads on the index options like NDX RUT. I've been doing those lately. They've been working out great. How to use non-directional credit spreads and when. How to steadily and consistently grow a small account. This is really another great thing about options and income option strategies is that you can take a small account, $5,000 or something that's small, and through these limited low-cost type strategies, you can start increasing those small accounts with a low-risk type strategies into a larger account. And then the key thing too is how to defend the trade and when to make, and even make money when you're wrong. So I'll go through an example here of one. I've got like 5 different defensive measures that are taught in this course, and one of them was, it will give you an example of, it was on Tesla when I just, I was down over $600 per option contract and turned that into a break even using this one defensive strategy. So that's covered, which is pretty cool. And then, the other thing is when to use iron condors and when not to use them, because, it's something that I don't use all the time, but a lot of traders think, okay, I'm going to always do an iron condor because I get that double premium, but that's going to be a curse. So that's going to be gone through. And then the really cool thing, this is worth $97 alone, is how to turn a 70%, or say a 1 standard deviation, 68.2% probability of winning, into 90% probability of winning. This is worth it right here to see how you can go from 70% to greater. Now, the other thing is iron butterflies. I'll cover a little bit of that. And then the step-by-step guide for executing the spreads and the best technical analysis techniques to use for your trade setup. So I incorporate the technical support resistance and Fibonacci in there. So a lot of this goes through all that. The best market times for those spreads and how to trade those spreads into the day so you're not glued to your screen getting bug-eyed. So it's a lot in this course. So there you go, and I'll put it in one more time and I'll get into your questions here. Let's see here. What are the differences in trading spreads on indexes versus ETFs? Okay, good question, Adam. The thing is the premiums that you collect. The ETFs, unless you're using the levered ETFs, you're not going to get much premium. So the ETFs I find are really great for buying type option strategies because the bid-offer spreads are tight and the premiums are really low because the volatility on the ETFs is a lot lower than like a stock or a futures because they're smoother because you don't have to worry about because it's a basket of things. But on the index options, you have much bigger premiums to work with. So I like the index options for that. Yeah, and they're definitely the differences. Are there differences in the expiration times and dates? Yeah, absolutely. The index options, you can go out way out, and there are a lot of differences there as far as the time to expiration and all that. And the key, though, is to understand the standard deviations. And if you've ever heard Tasty Trade, they had an interview with this lady, Karen, the super trader. It was an amazing story if you've not seen it. But anyway, it's all based on her aha moment of playing with options and understanding that for selling premium really turned it around for her, and she's just amazing. I mean, she made a huge amount of money. So that's the cool thing about it. And this is what I teach you in this course: is the standard deviations is the key to it, the probabilities of these trades winning or losing. So once you understand the statistics, and it's real simple because you've got all the tools there on your option platform. So once you understand those statistics, then you can do these trades, and that's what I teach in this course. And it's not that complicated, and you get the recordings, and you go back step by step. You get all that stuff, and then, for the first 20 of you guys, if you sign up here today, you're going to get that follow-up Q&A, which is going to be invaluable. So take advantage of it. Let me go back through some other questions here. Is there a book that you can recommend to learn about options? Yeah, you can buy this course, no pun intended, but this will be the best book you could possibly buy because I'm stepping you through everything on what you needed to know rather than reading a 300-page book. This goes through what you need to know and how to use it in reality versus theoretically, and then also step-by-step examples with the videos, so you can see it rather than, you've got the PowerPoints that you can use as your guide for your books to use your notes, but then you've got the videos with real trade examples. So I like to learn visually from examples, and this is, really helps me as far as my learning style. Yeah, the Q&A. Yeah, the Q&A. Gene says the Q&As are worth their price, and that's really great to have these follow-up Q&As. So I highly recommend that you jump in here now and get one of those 20 spots. Going back here through questions, a lot of great questions. What capital is needed to trade option credit spreads? Well, the capital, you can start out with $5,000. A lot of the capital requirements, though, will be based on what your broker will allow, but you can shop around the different brokers to see. But, you can start out with a small $5,000 account, and options are a good way to go because, you can get into some trades that are cost you very cost efficient and cost little and know your defined risk. Can you comment later on comparing option trading versus futures trading, risk and leverage? Yeah, well, I like futures too. I like futures for day trading, and I like options for those longer term, could be 1 day to 3 to 4 days to a month to a year, because options, because of their name, just give you so many different ways that you can skin the cat. So, you can buy the directional options like we showed in the example. You can buy in-the-money options, out-of-the-money options. You can do credit spreads with futures. You buy it at the price, and that's it. It's black and white. With options, you just got so many more different ways you can go. So the thing is, with a $97 course like this, you can explore this to see if it's something that works for your style, and it's a low-cost way for you to get involved. Could you relate the #1 option trading mistake? I came late. Yeah, the #1 option trading mistake is that most new traders or even new option traders get intoxicated by that leverage, and they'll buy out-of-the-money calls because they're cheap, and then they end up always losing money because they never get, either one, they don't get the direction right, or two, they don't get the timing right, or three, they get both of them wrong, or they might get one right and the other wrong. So there are just too many things that you have to get right for a directional option trade that's out of the money to work and make you money. So if you're going to buy options, most of the time it's better to buy in the money with a higher, what we call a higher delta, or do a credit spread where the credit spreads have the highest probability of winning of any option strategy. Now they're going to make you less money, but that's because they're lower risk. So risk reward, right? The higher risk things are going to make you more money, right? But the lower risk are going to make you less. So that's the credit spread. A lot of people can't get their arms around the credit spread. They'll see that they'll maybe make $100, but they could lose 400, and they think, oh well, that's just too much risk. But what you're missing is that the probability is that that particular trade might be the probability of success based on statistics, which I teach in this course, is a 70 to 80% probability of winning versus losing. I've never traded leaps. Are they liquid? Very, very liquid. Well, again, it depends on what you're trading on, but on ETFs, very, very liquid. Depending on the ETF, but very liquid. Why would you have not sold your option in 3 days? That was the example on when. Yeah, that's a great question. Looking back at it, I probably would have, but I was just trying to illustrate an example, because on when, in a lot of these earning trades, there are a lot of stocks that after their earnings release, they'll trend in the direction of the move they made after the earnings release. So on that particular example, actually, when tends to trend after earnings. So that was a great spike, but a lot of times, most of the time, probably 80–90% of the time, wind goes in the direction of the release of its earnings. On that particular time, it got crushed. I think the markets in that particular time frame got hit real hard too. So, that hurt. But that was to illustrate a point, really, the example of the difference between the two. I had a problem defending the spreads. That's very important. Yeah, Rick, that's a big problem, defense. So the key to defense is putting on the proper type trade setup, when to put this trade on, when not to put the trade on, and then how to defend it if it does go wrong. So in this course, I've got 5 different defensive strategies to use. But a key one is when to put the trade on. So that's a lot of it too, and that's taught in this course. Okay, here's that link again. And again, the first 20 that sign up here today will get the follow-up Q&A. So what would the exit strategy be if it goes against you? In this course, I show you the exit strategies. There are different types of strategies, so, and for different type situations. So in this course, it'll go through the different strategies. Going back here. All right, so let's see here. Does your cover cover delta, theta, Black-Scholes values to initiate trades? The course covers delta, theta. You don't use, on these, all these option platforms have their own internal calculations that are, based on Black-Scholes. So you don't have to put in everything. On Black-Scholes, you have to put in interest. There are about 5 different variables that go in there, but you don't need to know those. I mean, it's automatically done for you, which is the nice thing. Okay, great. So you put in, if you put in Power Cycle Trading /offer, that'll give you the course for $97. And then the first 20, let's see, yeah, filling up fast. First 20 I'll take in for the follow-up Q&A, and I'll send out an email on that, on the Q&A. Any other questions? Now the other thing too is with options, again, I can't say it enough times, but you have all these really great tools on your option platform, so you can really take advantage, of these free tools. They show you so much, and the thing that I love too is that you can do theoretical pricing, so you can see, you can adjust a date or a price if the underlying goes up $1, $10, whatever. You can see what that price of the option would be in the future, so it really helps you a lot to do that. Oh, great. Okay, Paul. Yeah, the trading club. Yeah, the trading club is my membership club, and you get we do a weekly Q&A. So for all the members, you get a weekly Q&A where you come in and ask any question about any trading subject or problem you're having, or anything that we're doing. And so then I also put out a daily video newsletter on what the markets are doing, what they're doing directionally, trends, new trends that are developing. I've put out trade alerts on anything I'm seeing. I'll put out a video alert to my trading members. We also have a point reward system, so for every month you're in, you'll get a certain amount of points that you can use towards courses that I have. You get discounts on all my current courses and future courses. And then I also do a quarterly bonus. It'll be what I call the surprise bonus. And then I also have a daily virtual trading room that you can come in. It's open all day, and I'm in there for the first first on the open and on the close for trade setups. These are digital courses. There's not a DVD on this, so you can just, as soon as you sign up, you're going to be auto-directed to a login information and things that you need there. So the Trading Club is a really great value. It's $7 to sign up for the first 30 days, and it's $97 per month. But for that $97, you get Q&A every month, every week, excuse me, and then a lot of other great bonuses. Yeah. Oh, thanks, Gene. Gene is one of my members. He says the Trading Club is a good mentor environment too. Yeah, I give a lot. I give a lot to my members. Well, the ebook, that's an ebook, but this course more is you have to buy this course, and then this course is the PowerPoints and the videos. So I do have a free ebook on my site, but that's a free ebook. That's totally different than what we're talking about here. Here's the link again. Send me an email, Jim. If you buy the course, then you'll get the opportunity to pick up the club. Here, you put this link. I believe will give you the course. Try this link. You put that link into that. I think that will give you the club sign-up page. So that's just for the club. But if you buy the course here today, you're going to get redirected to join the club as a follow-up. So you can either say yes or no, and you get the opportunity to join the club. Yeah, Paul, the course, well, it's Saturday, and we have these things set up on the autoresponder, but it's a computer. Sometimes the autoresponders don't work exactly like you want them to do. And we're a small company, so I don't make my people work all weekend. So if you don't get it today, you'll get it Monday. You don't see the address? Not sure exactly what that means, Jim. But if you have any questions, you can go to support@powercycletrading.com. Where am I located? I am in Austin, Texas. Where are you, Paul? Yeah, Gene, the course was the mastery course, Gene. If you have any questions on that, just send me an email, but you get that on a big discount. Plus, you can apply your credit. I think you already did that, though, didn't you? Salem. Oh, you're in North Salem, New York. I bet it's pretty up there right now. Oh, Israel. I want to go to Israel. I love Westchester. Got a lot of friends up in that area. Bedford, New York. One of my good friends lives in Bedford. Okay, you're welcome, Michael. But this link is easier, but you can, if you did on the site, that's cool too. Oh, no. Question, is this the same course as Thursday night offer? No, Gene. This is the Thursday night course is an upcoming Mastery Bootcamp all-day event on next Saturday, which will cover income options, but it'll cover a lot more than just this. Yeah, Bedford. I love Bedford, man. That's beautiful in there. Are you close? You're probably close to there, right, Paul? Westchester, you're further up. All right, guys, I appreciate everybody taking their time here today on a Saturday, and I hope you have a great rest of the weekend and enjoy a Father's Day tomorrow. Yes, excuse me, Robert. Yeah, this is a credit spread trading course. It's just 100% on credit spreads, bear call credit spreads, bull put credit spreads, iron condors, and then all the things that you need to know for those. Mostly, a lot of statistics, how to, use standard deviation, which a lot of people don't know how to use, which once you understand that, even if you don't use options, if you understand standard deviations of a move potential probabilities, it's going to help your overall trading in general. Well, with credit spreads, what size account for index options? With credits, with the credit spread, you can do, trades that only cost that only have an exposure of $500 or less, because you're going to be selling. Let's say you have a $500 spread. Let's say you sell. This is just an example, that $400. Say on the index you sold a $400 strike, and for insurance you bought the 405. So what's your exposure? $500. That's less your credit that you received. So let's say you received $100 credit. So then your margin is the difference. So you're going to have to put up with that broker. He's going to keep $400. Now that's in theory, but then you have to see what the broker says for you to do. Yeah, Hageth, trading is a journey, so I'm constantly learning each and every day. So you're going to definitely pick up some things that they're definitely going to help you. It might really be the turning thing for you, but there's definitely going to be something in there that's going to really help you. It's a lot of information. I put 4 hours of my time into it. Yeah, the max loss would be $400, correct. But see, with the credit spread, you want to keep that $100, so you're not going to let this thing. That's one thing too, is you're going to learn. You don't let it turn into $400 loss. That's going to be your max loss. But there are different strategies to use for defense where you're going to keep it from being a $400 loss. But that's just going in. If the world, something happens, an event happens, the max loss you're going to have is 400. So it's not going to be anything greater than that. And that's something for you to determine. Well, is that something you can live with if something crazy happens? But these are going to be out of the money when you're doing credit spreads. They're not, well, they can be at the money, but a lot of times they're going to be out of the money, which gives you some room, right? Sometimes it gives you a lot of room, because Karen, the super trader at Tasty Trade, she was selling 2 standard deviations, but she's selling naked options, which you can do too, but they're just a higher risk. Well, I hope you do, Paul. I hope you sign up for the trading club later. You'll get a lot of value out of it. Well, thanks again, and appreciate everybody taking some time on Saturday. And thanks, Mark, for putting up with me here today.
Oh, Larry, great to have you here. I appreciate your time, and I didn't realize you lived down in Austin. I'm here in Austin as well. So
You're in Austin?
I am. Yeah.
Well, shoot, man, we're gonna have to get together.
That would be greit. Grab some lunch or something. What part of are you in, north or south?
I'm, I guess, northwest, 2222. Going towards 620.
Yeah, near Steiner.
Yeah, are you in Steiner?
No, we used to be. We're actually up over in the Cedar Park area now. I'm actually we run the Leander School District for my kids. So.
Oh, sure. It's crazy where I live. It is so weird. Just on the subject, not to get caught up too much. Where we live, our house, our kids were in the Austin school district, and directly across the street, the house directly across the street was in the Leander. It's the weirdest thing I've ever seen.
Yeah, sometimes those dividing lines don't make a lot of sense, but it makes a big difference in terms of taxes around here, that's for sure.
It sure does. It sure does.
I'll shoot you an email, and if you're free for lunch,
Yeah.
it'd be great to meet you in person. So.
Yeah, it's Larry@powercycletrading.com. That is crazy. I thought for some reason I was thinking I thought you were in Florida or Chicago or something.
Yeah, we used to live in Naples, Florida, and on a
Nice.
side note, my wife actually lived in Bermuda for a number of years.
Did she really?
Yeah, I loved it. Absolutely loved it there.
What was she doing there? When was that? When was she there?
That was when she was growing up. Her father was actually stationed there in the Navy.
Ah, yeah. I lived there for I think it was 17 years. I forget. But it was a wonderful place to live. We loved it.
Yeah, I'd love to hear your stories about that. That sounds great.
Oh yeah, I got some good ones. So,
excellent.
Well, thank you so much.
Yeah, it sounds great. I'll reach out to you here this next week. But we appreciate you coming and speaking. This was great information. And again, for those of you who have not signed up for this course, I don't want to speak out of school here, Larry, but I'm sure it doesn't come any cheaper than that. So.
No, it doesn't.
Yeah.
We put a lot of time in our I mean, like for Mark's stuff, and we put a lot of time in this stuff, guys. I mean, we've got 20, 30 years of trading experience, and we try to make the best stuff we can because we want. I want everybody to be successful, because if you're successful and happy, I'm doing a good job, and I pride myself in trying to do the best I can. And the other thing too is service. We're small, so sometimes people get, we had a glitch about a week or two ago with one of our automated processes, and it was a total nightmare. But our service, if you have a problem, we always take care of it. So. Just to let you know that. But we're small, and we'd like to keep it that way, but we've got great people that help us, and we want everybody to be successful. So, all right. Well, thanks very much.
Okay. Yeah. Thank you, Larry, again. And thanks, everybody, for joining us Saturday morning. Have a great day. It looks like great weather around the country, and good luck trading.